Hello investors, my name is Alex and welcome to the Intelligent Investor. In this video I'm going to talk about investing in the stock market for long-term profits. Hello investors, I'm Alex. In today's video I'm going to be talking about investing in the stock market for long-term profits. Basically I'm going to be sharing with you guys my thoughts, my opinion, and so let's get started. So the number one reason why people invest in stocks is because they are looking for wealth or for capital appreciation. Of course, there are some people that also invest for income, commonly known as dividend investing, but this is a topic that I would be discussing in another video. Investors seeking growth would rather see the money that could have been distributed as dividends be reinvested in the company so that a greater gain is achieved when the stock price rises or appreciates. So people interested in growing their wealth see stocks as one of the most convenient ways to do it. It's true that growth stocks tend to be riskier than other categories of stocks, but it's also true that growth stocks offer excellent long-term prospects for making people rich. Investor, if this is the first time in my channel, consider subscribing. Just to give you an idea about what I'm talking about, look at what investors such as Warren Buffett, Peter Lynch, and other successful investors have accomplished through time. And even though Warren Buffett is not considered a growth investor, his long-term, value-oriented approach has been a successful growth strategy. If you're the type of investor who has enough time to let somewhat risky stocks trend upward, or who has enough money so that a loss won't devastate you financially, then growth stocks are definitely for you. As some of the great investors outside say, no guts, no glory. So the challenge here is to figure out which stocks will make us richer quicker. So we as investors, we have to believe that we are the owners of a company and take interest in their products, services, sales, earnings, and so on. This attitude and discipline can enhance our goals as stock investors. This approach is especially important if our goal is growth. So to become a value-oriented growth investor, we have to take into account a few things. A stock is considered a growth stock only when it's growing faster and higher than the overall stock market. Basically, a growth stock performs better than its peers in categories such as sales and earnings, while value stocks are stocks that are priced lower than the value of the company and its assets. And we can identify a value stock by analyzing the company's fundamentals and looking at the key financial ratios, such as the price-to-earnings ratio or PE ratio. Also, growth stocks tend to have better prospects for growth in the intermediate future, let's say from 1 to 4 years. But value stocks, on the other hand, tend to have less risk and steadier growth over a longer term. Growth investors, for example, don't worry about buying companies at PE ratios of 30 or 40 or even higher, while value investors get too nervous buying those stocks at those PE ratio levels. Long-term growth stock investors spend a lot of time analyzing the company's fundamentals to make sure that the company's growth prospects lie on a solid foundation. Growth includes but is not limited to health and growth of the company's specific industry, the economy at large, and the general political climate. So the bottom line here is that growth is much easier to achieve when we seek solid, value-oriented companies in growing industries. It's also worth emphasizing that time, patience, and discipline are key factors in our success, especially in these tumultuous and uncertain times. Value-oriented growth investing probably has the longest history of success compared to most stock investing philosophies. The track record for those people who use value-oriented growth investing is definitely enviable. For example, investors like Warren Buffett, Ben Graham, John Templeton, and Peter Lynch are a few of the very well-known practitioners of value growth investing. Each one of these great investors have their own spin of the concepts, but all have successfully applied the basic principles at value-oriented growth investing over many years. Now let's see how we can choose growth stocks. There are many ways to choose growth stocks. For example, you can look at the investing environment. For example, you can look at politics, economics, demographics, and so on, and then choose which industry or sector will benefit from these conditions. Then, once you know which industry or sector will prosper accordingly, you can start by analyzing individual stocks. Now, once you choose a stock, you should wait patiently. Patience is more than just a virtue. Patience is to investing what time is to a seed that's planted in fertile soil. The legendary Jesse Livermore said once that he didn't make his stock market fortunes by trading stocks. Instead, his fortunes were made in the waiting. So, why does this happen? It happens because when a stock market has more buyers than sellers, the stock price rises. As time passes, more and more buyers find your stock. As the stock price rises, it attracts more attention and therefore more buyers. The more time that passes, the better your stock looks to the investing public. Remember, when you're choosing your growth stocks, you should consider investing in a company only if it makes profit and if you understand how it makes those profits and from where it generates sales. And as I said, part of that research starts looking at the industries, the sectors, and the economic trends in general. Now, when looking at leading companies, you should look at a strong company in a growing industry, which is a common recipe for success. If you look at the history of stock investing, this point comes up constantly. Investors need to be on the alert for megatrends because they help ensure success. A megatrend is a major development that has huge implications for much, if not all, of society for a long time to come. Now, here's the thing. We need to compare a company with something, for example, with the last quarter, year, industry, sector, or even the stock index. The idea here is that we have to measure the growth of a company against something in order to figure out whether that stock is a growth company or not. Usually, we compare the growth of a company with growth from other companies in the same industry or with the stock market in general, as I said. In practical terms, when we measure the growth of a company against the stock market, we're actually comparing it against a benchmark such as the Dow or the S&P 500. Now, here's the thing. A stock is considered a growth stock not only because the company is growing but also because the company is performing well with some consistency. Another point to have in mind is to consider companies with a strong niche. Companies that have established a strong niche are consistently profitable. So when looking for companies, we have to look for one or more of these following characteristics. A strong brand. For example, companies such as Coca-Cola and Microsoft come to mind. Of course, other companies out there can make soda or softwares, but a business needs a lot more than that. Another thing that a company has to have is high barriers to entry. For example, UPS and Federal Express have set up tremendous distribution and delivery networks that competitors can't easily duplicate. High barriers to entry offer an important edge to companies that are already established. Examples of high barriers include high capital requirements. In other words, companies that needs a lot of cash to start or special technology that's not easily produced or acquired. And finally, research and development. Companies such as Pfizer and Merck spend a lot of cash in research and developing new pharmaceutical products. This investment becomes a new product with millions of consumers who become loyal purchasers so that company can keep growing. Now, next in the list is checking out a company's fundamentals. When we hear the word fundamentals in the world of stock investing, it refers to the company's financial condition and related data. When investors, especially value investors, do fundamental analysis, they look at the company's fundamentals. For example, its balance sheet, income statement, cash flow, and other operational data, along with external factors such as the company's market position, industry, and economic prospects. However, the main numbers that we want to look at include the following. Sales. Are the company's sales this year surpassing the last year's? As a decent benchmark, we want to see sales at least 10% higher compared to last year. Although it may differ depending on the industry, a 10% is reasonable. Earnings. Are earnings at least 10% higher compared to last year? Earnings should grow at the same rate as sales or hopefully better. Debt. Is the company's total debt equal or lower than the prior year? A company's financial condition has more factors than I covered here, but these numbers are the most important. I also realize that using the 10% figure may seem like an oversimplification, but you don't need to complicate matters unnecessarily. We also have to evaluate a company's management. The management of a company is crucial to its success. Before we buy a stock of a company, we want to know that the company's management is doing a great job. But how do we know that? How do we know whether the management is running the company properly? The best way is to check the numbers. One of these numbers is return on equity. Even though we can measure how well management is doing in several ways, we can take a quick snapshot of a management team's competence by checking the company's return on equity. We can calculate the return on equity simply by dividing earnings by equity. The resulting percentage gives us a good idea whether the company is using its equity or net assets efficiently and profitably. Basically, the higher this number is, the better. But we can consider also this number solid if the percentage is 10% or higher. Also, we have to bear in mind that not all the industries have identical return on equities. Other indicators are equity and earnings growth. And finally, insider buying or share buybacks. Watching management as it manages the business is important. But another indicator of how well the company is doing is to see whether management is buying stock in the company as well. If a company is poised for growth, who knows better than the management? And if management is buying up the company's stock in mass, that's a great indicator of the stock's potential. And last but not least, we have to notice who is buying and or recommending a company's stock. We can invest in a great company and still see its stock going nowhere. Why is this? Because what makes the stock going up is demand. In other words, having more buyers than sellers of the stock. If we pick a stock for all the right reasons and the market notices the stock as well, that attention causes the stock prices to climb. So, the things to watch for include the following. Institutional buying. Are mutual funds and pension plans buying up the stock you're looking at? If so, this type of buying power can exert tremendous upward pressure on the stock's price. Frequently, when a mutual fund buys a stock, others soon follow. In spite of all the talk about independent research, a herd mentality still exists. Another point on this list is the analyst's attention. Are analysts talking about the stock on the financial shows? As much as you should be skeptical about an analyst's recommendation, it offers some positive reinforcement for your stock. But don't ever buy a stock only on the basis of an analyst's recommendation. Just know that if you buy a stock based on your own research and an analyst subsequently rave about it, your stock price is likely to go up. A single recommendation by an influential analyst can be enough to send a stock skyward. And last but not least, newsletter recommendations. Independent researchers usually publish newsletters. Investors, If you enjoyed this video and you feel it was valuable and teaching you more about investing in the stock market, hit the like button and please share the video with your friends and family so that more people can benefit from its content. And if you want more investing content, please subscribe to my channel. Thanks for watching.